revenue up almost 21%, operating income up nearly 43%, and free cash flow more than 10 times what it was a year earlier. Those three numbers describe the same company over the same 6 months, Texas Instruments. When profit grows at twice the rate of sales, something structural is happening underneath, and it is usually one of two things: genuine operating leverage or an accounting effect that flatters the picture. In the next 10 minutes, we separate the two, using only what is in the filing. Texas Instruments designs and manufactures analog and embedded processing chips, the unglamorous silicon that regulates power, converts signals and controls systems inside industrial equipment, cars, and electronics. It owns and runs its own fabrication plants, which matters for everything that follows. Two notes on the basis. Everything here comes from the 10Q covering the first 6 months of the fiscal year, ended the 30th of June, filed on the 24th of July. The income statement and cash flow figures are cumulative for those 6 months and compared with the same period a year earlier, not a standalone quarter. The balance sheet compares against the end of the prior fiscal year, so those changes are since the start of the fiscal year. Start with the top line. Revenue for the 6 months was $10.3 billion, up 20.8% against the same period last year. Gross profit rose faster to $6.2 billion, up 25.8%. Operating income rose faster still, $4.1 billion, up 42.6%. Net income landed at $3.5 billion, up 42.5%, and diluted earnings per share were $3.82 against $2.69, up 42%. Notice that per-share growth almost exactly matches net income growth. Diluted share count was 917 million versus 914 million, essentially unchanged. None of this came from shrinking the share count. Here is where the growth comes from. Cost of revenue rose only 14% to $4.1 billion, while sales rose almost 21%. That gap lifted gross margin to 59.8% from 57.4%, up 2.4 percentage points. Then the operating expense lines did nothing at all. Research and development was $1.045 billion, $1 million more than last year. Selling and administrative expense was $954 million, $3 million less. Revenue grew by $1.8 billion while those costs stood still. That is why operating margin jumped to 40% from 33.9, 6.1 percentage points, and net margin to 34.3% from 29. Fixed costs spread across more volume. Textbook operating leverage. A margin move that large deserves skepticism, so tested against cash. Operating cash flow for the 6 months was $4.2 billion, up 55.9%. That is faster than net income at 42.5% and much faster than revenue. Cash from operations exceeded reported net income by about 20%, so the profit is more than fully backed by cash. Second test. Where in the income statement did the profit appear? Pre-tax income was $3.95 billion, below operating income of $4.1 billion. Interest and other items were a $166 million drag, not a gain, so nothing was manufactured below the operating line. The earnings are operating-driven and cash confirmed. Now the mix. Texas Instruments reports 3 revenue lines, and they are not moving together. Analog is the engine, $8.3 billion of the $10.3 billion total, 80.6% of revenue, growing 24.4%, faster than the company as a whole. Embedded. Processing contributed $1.5 billion, 14.7% of revenue, up 14%. Solid, but roughly half the pace of analog. The third bucket, all other, is $488 million, and it shrank 7.8%. So the biggest segment is also the fastest grower, and the only decliner is the smallest line on the page. Growth here is concentrated, not broad. That concentration cuts both ways. When 4 of every 5 revenue dollars come from one segment compounding at 24%, and the company runs its own fabs, utilization does the rest, run the plants hotter and fixed manufacturing cost spreads over more units. The same arithmetic reverses. If analog demand cools, Revenue falls against a cost base sized for higher volumes, and the 2.4 points of gross margin just gained can unwind at least as fast as they arrived. Nothing in these numbers is broken, but the margin level is a function of where in the cycle this business currently sits. Cash flow needs its own slide because the headline number here is the most flattering in the filing. Operating cash flow was $4.2 billion, up from $2.7 billion. Capital expenditure was $1.19 billion, down from $2.43 billion, essentially halved. Subtract one from the other, and free cash flow was $3.03 billion, against $281 million in the same period a year ago, more than a tenfold jump. But look at the composition. Roughly $1.25 billion of that improvement came from spending less on fabs, not from earning more. The prior year base was depressed by a heavy investment cycle. The operating cash flow gain is genuine. The tenfold optic on free cash flow is a comparison artifact, not a run rate. So where does the cash go? Dividends paid over the 6 months were $2.59 billion, up from $2.47 billion. Buybacks were $185 million, down sharply from $955 million a year earlier. Together, distributions of about $2.77 billion against free cash flow of $3.03 billion. Covered, but with only around $260 million to spare, and in a period when capital spending was halved. Last year, the same distributions ran far ahead of free cash flow of $281 million, and the gap came out of the balance sheet. The buyback is clearly the flexible line. The dividend is not. The balance sheet improved on every axis. And remember, this comparison is against the end of the prior fiscal year, not year over year. Total assets were $35.9 billion, up 3.8% since the start of the fiscal year. Total liabilities fell 2.4% to $17.9 billion. Equity rose 10.7% to $18 billion. Liabilities now sit just below equity, where at the start of the year they were comfortably above it. Long-term debt came down to $12.9 billion from $13.5 billion, putting reported debt to equity at 0.99 times, and retained earnings added $925 million. The company de-geared using its own cash, with no issuance involved. Liquidity is wide. Cash and equivalents were $3.66 billion, up 13.5% since the start of the fiscal year, alongside short-term investments of $3.34 billion. That second line doubled, from $1.66 billion. Current assets of $15.8 billion cover current liabilities of $3.2 billion, nearly 5 times over. The current ratio is 4.86. Inside working capital, 2 lines moved in opposite directions. Inventory fell to $4.6 billion from $4.8 billion, which is unusual with revenue up 21%. Shipments outran restocking. Receivables went the other way, up to $2.52 billion from $1.96 billion, which brings us to what is worth monitoring. First, those receivables, up 28.4% since the start of the fiscal year against revenue growth of 20.8%. That is a mild divergence rather than an alarm, but sales are being converted to cash slightly more slowly, and days sales outstanding detail is not in the filing. Second, tax. Income tax was $427 million on pre-tax income of $3.95 billion, an effective rate near 10.8%, well below statutory. It was 10.2% last year, so it is low but stable rather than a one-off, and the drivers are not disclosed in the data available. If that rate normalizes, net income compresses with nothing changing in the operating business. Third, whether the reduced capital spending run rate holds is simply unknown. 2 housekeeping signals. On insider activity, the data shows 0 open market purchases and 0 open market sales, with an empty transaction list, so we cannot even separate a quiet window from one where only routine grants and tax withholding occurred. Read that as absence of information, not as a negative. On corporate events, there is exactly one item in the period, an 8K dated the 22nd of July, the quarterly results press release, which referenced non-GAAP free cash flow measures. The 10Q followed 2 days later. No acquisitions, no leadership changes, no new capital authorizations, no guidance revisions. The catalyst flow is routine, so the reported numbers carry the story alone. Three things to carry away. 1. The profit growth is real and cash confirmed. Operating costs held flat in absolute dollars while gross profit rose $1.26 billion and cash from operations exceeded net income. 2. The free cash flow headline overstates it because roughly half the gain came from having capital expenditure against a depressed prior year base. 3. 80% of revenue sits in one segment riding a cyclical upswing, and the leverage that added 6 percentage points of operating margin works just as efficiently in reverse. Next quarter, 3 lines to watch. Whether gross margin holds near 59.8%, where capital expenditure settles, and whether receivables growth converges back toward revenue growth. A business in the expansion phase of its cycle, currently converting that expansion into cash. Figures from the SEC filing. Educational only, not investment advice.